Did you know that it's possible to replace your full-time income with dividends in less than a decade? Imagine not having to work, but instead, your investments pay all your bills. Back in 2015, I met someone who achieved just that. Their story wasn't just inspiring, it was a blueprint. They started with a modest investment and strategically chose stocks known for high and stable dividends. Fast forward a few years, and they were living a life many only dream of, all funded by dividends. Understanding how to replicate this success is crucial. Mastering dividend investments can lead to financial freedom and security, while neglecting it might leave you dependent on a 9-to-5 job longer than necessary. Today, I'll share proven strategies to help you build a robust dividend portfolio fast, so you too can start living on your terms. If you found today's insights on dividends helpful, imagine what more you could learn by joining our community. Don't miss out on our upcoming analyses and tips. Make sure you're subscribed and have notifications turned on. Stay ahead in your financial journey. Understanding dividends. When we talk about dividends, we're discussing a portion of a company's profits that is distributed to shareholders. Essentially, when you own dividend-paying stocks, you are part owner of a company, and dividends are your share of the earnings. Think of it as getting paid for your trust and investment in a company's success. But not all companies pay dividends. Those that do are often well established with a steady profit stream, making them attractive for investors seeking regular income. Dividends are usually paid on a regular basis, monthly, quarterly, or annually. The amount you receive depends on how many shares you own and the dividend rate set by the company. The decision to pay dividends, and how much, is made by a company's board of directors. It's a signal of financial health and confidence in future earnings. One crucial concept in understanding dividends is the dividend yield. This is the percentage of the stock price that each dividend payment represents. It's calculated by dividing the annual dividends per share by the stock's current price per share. For instance, if a stock is priced at $100 and pays a $5 dividend annually, its dividend yield would be 5%. A higher yield can be tempting, but it's essential to consider the reasons behind it, as it might indicate risks or stock price volatility. Chasing the highest dividend yield isn't always the best strategy. Stability, growth potential, and the underlying business model are equally important to ensure that dividends are not only sustainable, but potentially growing. In summary, dividends are your share of a company's profits, paid out as a reward for your investment. Understanding how they work is the first step towards building an investment strategy that could allow you to live off your investments one day. Essential strategies to maximize dividend income. Strategy 1. High dividend stocks. In the quest for a steady income from investments, high dividend stocks are often the go-to choice. These are shares of companies that pay out a higher percentage of their profits in the form of dividends, promising appealing returns to their shareholders. Let's take a closer look. A high dividend stock typically offers a yield that's above the market average. For many investors, this means a reliable stream of income, especially appealing during times of market uncertainty. However, the allure of high yields comes with its caveats. Not all high dividends are sustainable, and they can sometimes be a red flag for underlying company issues. For example, a company might maintain high dividends to attract investors despite poor financial health, risking future cuts in payouts, or worse, jeopardizing your principal investment. The payout ratio, a key indicator, measures the proportion of earnings a company pays its shareholders in dividends. An ideal payout ratio is typically between 50% and 70%. It shows that a history of dividend payments for consistency and growth. Investing in high dividend stocks can be a rewarding strategy if done wisely. With thorough research and a keen eye on financial indicators, you can tap into this source of passive income effectively and safely. Remember, it's not just about the high yield, but about the health and sustainability behind it. Company is both rewarding its shareholders and reinvesting in its growth. Seek out companies with a history of stable and gradually increasing dividends. This indicates not just current profitability, but also a commitment to future growth and shareholder value. Here's a quick checklist for you when considering high dividend stocks. Assess the company's financial health through its payout ratio. Check the stability of the industry it operates in. Strategy 2. Dividend reinvestment plans. DRIPs. One powerful way to accelerate the growth of your investment portfolio is through dividend reinvestment plans, commonly known as DRIPs. These plans allow you to automatically reinvest your dividends into additional shares of the stock, compounding your investment over time. By reinvesting dividends, you purchase more shares, which then generate their own dividends, leading to a snowball effect. Over the years, this can significantly increase the total value of your holdings without additional out-of-pocket expenses. Compounding is often referred to as the eighth wonder of the world. With DRIPs, you harness this power as your dividends buy more shares, increasing your future dividends in return. It's a virtuous cycle. Let's consider John, an investor who started with 100 shares. With a steady dividend reinvestment plan, his holdings could grow exponentially, providing him a substantial income stream by retirement. Strategy 3. Covered Call ETFs. Covered Call ETFs offer a unique approach to generating income. These funds hold a portfolio of stocks and simultaneously sell call options on those stocks, creating an additional layer of income on top of dividends. Here's how it works. The ETF owns stocks and sells call options, which gives someone else the right to buy the stock at a certain price within a specific period. This sale generates premium income, which is distributed to shareholders as dividends. Covered call ETFs can be particularly attractive in stable or slightly upward trending markets, where the option premiums can significantly enhance the yield on your investment. Strategy 4. Real Estate Investment Trusts, REITs. Real Estate Investment Trusts, or REITs, allow investors to earn dividends from real estate without having to buy or manage the property themselves. REITs collect rent from their properties, which is then distributed to shareholders as dividends. They must distribute at least 90% of their taxable income to qualify as a REIT, often resulting in high dividend yields. Investing in REITs not only provides regular income, but also diversifies your portfolio against market volatility. It's a tangible asset that can appreciate over time. Consider high-yield REITs in sectors like healthcare, residential, and retail, which offer different levels of risk and return based on market conditions. Strategy 5. Dividend Aristocrats. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. They represent stability and reliability in the investment world. These companies have a proven track record of not just paying but consistently increasing their dividends, making them highly sought after by long-term investors. Dividend aristocrats are often large established companies with dominant market positions, allowing them to weather economic downturns better than most. Incorporating dividend aristocrats into your portfolio can provide a steady, growing income stream and serve as a bulwark against inflation. Practical steps to start. Whether you're new to investing or looking to refine your strategy, here's how you can get started. Step 1. Assess your financial situation. Before diving into investments, understand your current financial health. Determine how much capital you can comfortably invest without impacting your essential expenses. Creating a budget is crucial. It helps you identify how much money you can allocate to investments monthly, balancing between saving, investing, and spending. Step 2. Open an investment account. Choose a brokerage firm that aligns with your investment goals and offers low fees. Many platforms also provide tools and resources to help you manage. Step 3. Research dividend-paying assets. Utilize financial news, investment apps, and analytical tools to find stocks, ETFs, and REITs with robust dividend histories and promising futures. Step 4. Calculate potential returns. Use online calculators to estimate the dividend yield and understand potential earnings. This will help you set realistic expectations for your income from dividends. Step 5. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across various sectors and asset types to mitigate risks and maximize potential returns. Step 6. Monitor and adjust. Regularly review your portfolio's performance. Make adjustments as needed based on market changes, personal financial goals, and life events. Continuous learning and adaptation are key to successful dividend investing. Meet Sarah, a dedicated professional who dreamed of financial independence. With a modest income but a strong will, Sarah decided to transform her financial future through the power of dividend investing. Sarah started by investing a small portion of her paycheck into high-dividend stocks and setting up drips to reinvest her earnings. Over the years, her portfolio grew, benefiting from the compounding effect of reinvested dividends. By consistently investing in a mix of dividend aristocrats and high-yield REITs, Sarah's initial investment of $10,000 grew to over $100,000. She reached a point where her dividend income could cover her basic living expenses. The key was consistency and patience. I didn't see significant returns immediately, but over time, my dividends grew, and so did my confidence in financial independence. Today, Sarah lives off her investments, her dividends providing a steady income stream that allows her to enjoy her passions without financial stress. Challenges and considerations. While dividend investing offers a pathway to financial security, it's not without its challenges. Market volatility, economic downturns, and changes in company dividend policies can impact your income. Consider the risk of investing in high-dividend stocks. Companies can reduce or eliminate dividends during financial hardships, affecting your income stream. To mitigate these risks, diversify your portfolio across different sectors and asset types. Also, consider building an emergency fund to buffer against periods when dividend payments might be lower than expected. Another consideration is inflation. As the cost of living rises, the purchasing power of your dividend income may decrease. Staying invested in companies with a history of increasing dividends can help counteract this effect. Lastly, the tax implications of dividend income can vary significantly by region and individual tax status. Understanding and planning for these taxes is crucial to maximizing your net returns. As we've explored today, living off dividends is more than just a financial strategy. It's a pathway to freedom and security. It allows you to harness the power of your investments to create a steady, sustainable income stream that can last a lifetime. Remember Sarah's story and how her dedication and strategic investing allowed her to achieve financial independence. Her journey exemplifies that with the right approach, patience, and perseverance, living off dividends isn't just a dream, it's an attainable reality. By understanding the various strategies, from high-dividend stocks to dividend reinvestment plans, and from real estate investment trusts to dividend aristocrats, you equip yourself with the tools needed to build and grow your dividend income. Start small if you need to, diversify your investments, and always stay informed. The world of dividends offers many opportunities, and the rewards can be substantial. So, what are you waiting for? Review your financial goals, consult with financial advisors if necessary, and take that first step towards building a dividend portfolio that works for you. Your future self will thank you for the freedom and peace of mind that comes with a well-planned dividend income.